Good evening, everybody. Let me introduce Stephen Silvester, who's our Finance Director, and Richard Starr, Executive Director and Property Director. So, PALACL Capital, we have made 10 acquisitions of properties since we got this organisation going in 2010, which I'll come to in a minute, and 6 have been corporate. 4 have been direct. We made corporate acquisitions, one because it was an opportunity for us, and one of the reasons we buy corporately is that certainly 2 or 3 years ago, companies had very high debt levels, and in consequence with high debt levels, the values of the companies were quite small, and if you buy the shares of the company, you only pay 0.5% stamp duty. You don't pay 4 or 5, what was 4% then, but it's 5% now. So we managed to buy corporately, and therefore, to us, we did a better deal. Secondly, which we'll explain in a minute on one of the deals we did, you buy the company, very often the base costs of each property are much higher because it was bought at the peak of the market. So when you buy it, you've got the benefit of losses. So corporate acquisitions have been very helpful to us. And we focused on that. So what we do is we enhance income returns. We look for long-term income but capital growth as well. I would say now we are not a REIT. REIT primarily focus on income. We focus on income, but we also look to grow the value of our properties as well. So we've got a very experienced management team. Stephen was at New River Retail, was financial controller, joined us last year. Richard has been in several senior positions in the property investment world, had his own firm, and then joined us full-time in July of this year. And we've got Andrew over there, who is at Orchard Fund Management, all highly experienced. We have 53 properties at the moment that, as at the 31st of March, had 174.5 million of property. That's been enhanced by a recent acquisition in Manchester where we paid 10.5 million. So you're talking circa 185 million. We only buy outside London. We have not focused on London at all. We took the view that the regions were forgotten, and London was starting to grow in 2010, started to pick up, but the regions did not. But our view was, as night follows day, the regions will follow London, and it might take 2 years. In fact, it took 3, but we knew if we could buy at the right point, which we did, everybody would benefit. So we believe that the regional property market is set to outperform London. I think the Investors Chronicle last week thought the same, but we do. And of course, the government are devising a lot of initiatives at the moment. You've got the devolution with the mayors in the regions. Secondly, you've got the Northern Powerhouse, which has received tremendous publicity. And of course, the Midlands engine, which refers to the area around Birmingham. But of course, you've now got, in addition to that, a government strategy to move a number of civil servants out of London. And we were today made aware that 7,000 civil servants will be moving to Leeds. Leeds is one city they've chosen, Liverpool is another, Manchester is another, and possibly Birmingham. This is our growth story since 2011. We took board control in 2010. PALACL Capital was called Leo Insurance. It was a little company that was floated in 2005. It went into the insurance business. It listed at 15p at 2005. It went to 26p. They bought a half interest in an insurance business in 2005 and then proceeded to do absolutely nothing. And we were looking for a little vehicle. We found Leo Insurance in 2010. It was the smallest company on the London Stock Exchange. It had a huge market cap of 108,000, and it was controlled by 2 brothers who just lost interest in it. We took board control. We sold the insurance business back to them, and we then started to focus on the regions. So what we had in 2010 was a tiny public company. We had £15,000 in cash and hope. That was it. But we started in 2010. One of the problems was, if you go back 6 years, the banks were still not releasing properties in distress. It just wasn't happening because for a long time they denied they had a problem. And we found it quite difficult to actually find an acquisition that suited us. But eventually we found a little portfolio in Cheshire owned by this 79-year-old guy who had 9 properties, built it up, and he wanted to sell it because he was getting married, which was wonderful for us. And we bought this company, 1.82 million, called HOUSL Estates. We borrowed 1.2, we raised £500,000 on the market, and we were on the road. In October 13, we bought a subsidiary of Quintain. Quintain had decided that regional property was no longer core to their business. A portfolio was then put on the market for 47 million. It didn't sell, they couldn't sell it. And that was when I met up with Richard Starr. We didn't know each other, but we belonged to the same golf society. So we met up and he mentioned to me that there was a portfolio that he thought could be bought. And we then went to see Quintain, and they originally wanted 47 million for this portfolio. But to cut a long story short, we agreed to pay 39.25 million for it, which is a far cry from 47. But what you should know is that they owed 38. So the value of the company was circa £1 million. So we paid round about £1 million for the company, which meant our stamp duty was only £5,000, which is the first thing. Secondly, the base cost of all those properties was much higher. So you have to go a long way before you got any prospect of any capital gains tax. Thirdly, the bank that was owed 38 million didn't really want all their money back, which was very good for us because at that time it was very difficult to raise debt on regional property. Regional property was still out of fashion. So what then happened, we agreed with Nationwide, who were the bank, that they would reduce the facility from 38 million to 20, and they would give us a new 5-year facility. We did that, and we then had to go to the easy bit, which is to raise the equity to complete the purchase. And if you go back to 2013, the economy was far different to what it is today. Secondly, regional property was still out of favour, so it was quite difficult in terms of having to raise the equity. So our chairman, Stanley Davis, and I went to see 8 brokers, and 6 were incredibly polite, but turned us down. 1 hummed and hawed, but 1 broker who we have today called Arden Partners said we may be right that there could be a regional upturn. And the reason we believed there would be a regional upturn is that Richard and I went to see every one of the 25 properties that we were buying in this portfolio. And from Bristol to Exeter to Stockport to Coventry, we were everywhere. Saw the lot in February of 2013. We met the tenants, we met the agents who were handling vacant space, all came out with exactly the same story, that business was picking up. So what we had a regional upturn, but the media hadn't got hold of it, and London had not got hold of it. And we thought, here is an opportunity, we've got to try and raise the money. So Arden thought they could raise the money, but it would take time. And to cut a long story short, we had to raise 23.5 million at £2 a share. We did 66 roadshows in order to raise that money. And the reason it was difficult is firstly, some of the people thought it was too small and they didn't want to be involved in a company worth only 25 million at the end. And secondly, a number of them just weren't convinced that the regions were picking up at all. But in the end, we got it over the line and we raised the money and away we went. And that was in October 13. And then in August 14, we bought a company called Property Investment Holdings, most wonderful name we've got there. And Property Investment Holdings was a company that was started by 5 families in the 50s. And by 2007, they had £60 million worth of property, mainly centred around Surrey, Sussex, nice places really. And they owed 30 million. So they had net assets of about 30 million. And one of the families that started this company was the Mackay family. And it was their public company called Mackay Securities who had 20% of this company. Anyway, unfortunately for them, two things happened. Firstly, there was the downturn after 2007, which was the first problem. But the major problem that hit them was to renew their bank facilities. The banks insisted that they took out swaps. And they renewed their banking facilities, but took out long-dated swaps going to 2031. So we went to see them in 2014. Their 60 million portfolio had been reduced to 32 million, both by selling and the downturn generally. And when I went to see them, before I went to Companies House just to see what their figures were. And it said their debt was 22 million. So naturally I thought they were worth 10 million. I was wrong. I didn't know about the negative value of the swaps because I didn't know that they didn't have to disclose them. And it's not in their accounts. But they told me when I got there. And the negative value of the swaps was 10 million. So in fact, the company had no value at all. So we're all looking at each other, wondering where the deal is. And the position was that these were a portfolio of 17 properties in Brighton, East Grinstead, Salisbury, Weybridge, Walton-on-Thames, all nice places. But they were broke. Simple as that. So we had to work out how we're going to do a deal. And we only thought the only way we're going to do a deal is if we can get the bank, both banks, to take a hit on the swaps. And we were told at the beginning there wasn't a chance of it. But there were two things. One thing to bear in mind, this was a time when they were still talking about mis-selling of these instruments. And we found that the Financial Conduct Authority had a policy that if you had assets of under 10 million, you were considered unsophisticated. And therefore you could claim that the banks had mis-sold you the swaps. But if you were over 10 million, you were considered sophisticated. And therefore you couldn't sue. So that was the argument with the banks when we spoke to them. The one flaw which we put over to them was this might be the attitude of the Financial Conduct Authority, but they're not the High Court. It's the courts of this country that decide whether there was mis-selling or no mis-selling. At which point we started to find out about one or two other cases where people were suing who were over 10 million. So in the end, we managed to do a deal with the bank, but instead of paying them back 32 million, we paid them back 28 million. So they took a 4 million hit on the swap. So we immediately created £4 million of value for the company. There was £600,000 of other liabilities. So we ended up buying the company for 3.4 million. And in order to convince the Royal Bank of Scotland to take a hit, we approached NatWest Bank, which at the time was run separately from Royal Bank of Scotland Finance, Property Finance, and they agreed to give us a new loan. So on the one hand, RBS are taking a hit, on the other hand, they're giving us a fresh loan. So we all ended up content, and we bought this portfolio. And we then raised a further 20 million. That was the time when Schroders came in as shareholders to the company. When we did the first fundraise, 4 shareholders backed us, in 4 principal shareholders, which was AXA, Henderson, Soros, and Polar Fund Management. But then in 2014, we raised £20 million at £3.10p a share, and we bought the company. And we paid for it in shares. We didn't even pay cash for it. The only cash we paid in respect of that deal was our advisors and the CEO who wanted to be paid out in cash. But other than that, that was it. So with that money, we then bought another property. In April of 15, we bought an office building called Bank House. We paid £10 million. We like buying properties in December and August. That's when the cat's away, and we step in. And we agreed to buy Bank House on Christmas Eve, in fact, of 2014, but we didn't actually do the deal till April. That building is a 90,000 foot building, which we'll refer to in a minute. Then we bought a leisure scheme in Northampton in August 15. It was one that was being sold to a US fund. It had been developed in 2002. It's 200,000 feet of leisure space plus a car park. It's about 2 minutes from the station. And what had happened, they'd agreed to sell it to a US-backed organization who at the last minute backed out. And the vendor decided to keep it. But then we heard about it. And he said, well, if you're paying me 20.7, I will still sell it. But that was a little bit pricey for us. So what we did, we asked him whether we could do a corporate deal with him where we could buy the company. So he had no objection to that. And we looked at the company and we found that the bank and a swap was already 18 million and there were shareholder loans of about 6 million. So the company itself was technically worthless. So in the end, we bought the company. It's a leisure scheme which has not succeeded. It's got an Ibis hotel, it's got a View cinema, it's got a Fitness for Less gym, and it had a gala casino, but it failed. And we decided we can do something with it, and we bought it in June 15. Again, because the company wasn't worth anything, we bought the company for £1, and we then took out a fresh loan with Santander to finance it. And we did a fundraising at 360p. And all our shareholders came in on that, and Unicorn came in for the first time. And over a period of time, we've also acquired Slater Investments and Hargreave Hale. So a couple of months later, we bought a building in Sutton, shop and office building, middle of the high street. Bought that one, just under £4 million. Again, it was a corporate deal, and we did that in August. Then an agent came to us just before Christmas in 2015 and said, there is an office building about 3 minutes from the station at Milton Keynes. It's not on the market, but they might sell it. And owned by an institution. Milton Keynes is in fact the fastest growing town in the UK. And we decided we're going to have a look at it. And the great thing about Milton Keynes, you can go to Euston Station, jump on a train, you're there in half an hour. And we got there, we walked up the road, 3 minutes, and we're at the building. Anyway, we bought that building for 7.2 million. And then, what then happened, we also got offered a leisure scheme in Halifax. Halifax is a town of 100,000 people. And Broad Street Plaza was a development carried out by a Leeds-based developer. He managed to get View. He's got TGI Fridays, he's got Wetherspoons, he's got all the people, Pizza Express, they're all in there. But he ran out of money. He had tried to sell it about 9 months earlier and failed. We had a look at it. And what we do with our due diligence is we try to get to know a town as well as we can. So we went up the night before to see the property. We stayed in the Premier Inn next door. And you'll find out more about Halifax talking to the manager of Premier Inn than you will from anybody else. And we got to know what was happening in the town, what was happening in the centre. The scheme was virtually fully let, 4 years old. But what had gone wrong is that in order to get tenants in, he had to give inducements to the tenants. So as an example, View, who took the cinema, wanted £750,000 fit-out costs. Well, he never had that sort of money. So in the end, he went into partnership with the contractor, which is what happened. And View went there, all took long-term leases, right? So we looked at this, and again, we looked as to whether we could buy the company. And the property was producing 1.8 million a year, and they were talking around £24 million to buy it. Now, we looked at the accounts of the company, and the company owed 31 million. So we thought, well, somebody's losing here, and it was the contractor. And we found that when we looked at it, the contractor, when we looked at it, was still owed £14 million from the contract he carried out 4 years earlier, which was not a very good situation for him. We then thought, right, this looks an interesting deal. There was a bank loan from Barclays of £15 million. It was worth 24 million in our view. It would cost us 9 million to do the deal. So in effect, we then looked at it more closely, and we also found that because it was in a trading company, they had never claimed capital allowances. And you can claim capital allowances on property. And we had a report done, and there was about £7 million worth of capital allowances that had never been claimed. So we bought the company for £1. We took over the loan from Barclays Bank, and which we'll talk about a little bit later. That's been since refinanced with Scottish Widows. We've now got a 10-year loan from Scottish Widows at 2.9% fixed. So our return on equity on that deal in July, when some of the rents go up, is going to be around about just under 17% return on our equity. So then finally, very recently, we bought a building in Manchester for 10.5 million. We only got that building because of the referendum. It went on the market openly, but most people in our business decided to go out of the market, but we didn't. And the vendor telephoned us and said, everybody's messing him about. So we bought this property at 75,000 square feet of offices. It's only 3 minutes walk from Manchester Piccadilly railway station. It's in a growth area, and it's all let at very low rents. So we think we've got considerable growth to come from that. This is our growth in net asset value since we did the Quintain deal at the beginning of October of 2013. And you will see that to the end of March, our growth in NAV surpasses all our peers. We were the best performing share in terms of growth of NAV. Now I'm going to pass you over to Stephen Silvester, our finance man, who will take you through some of the figures.
Thank you. Well, these are obviously dating back to March 16, so I don't want to spend too much time on them. But just to highlight, we're growing our income, we're growing our returns. You can see we've acquired properties along the way which are earnings enhancing, but we're also growing our NAV, which is the underlying value. So you can see EPRA NAV per share, FY15, so that was March 15, it was 396p per share. March 16, it's 414p. And obviously we're coming up to our half year, so we will update the market in a few weeks' time as to where that is. And then EPRA earnings is the European Public Real Estate Association. That's the measure that they use, which gives you an underlying earnings. So what you'll find is with property companies, if the market's going well, there'll be a revaluation gain going through the P&L, so you'll see a big profit for that year. And then if the market's going badly, you'll see a big dive in the profit and loss. This is purely that is a fair value movement. Okay, so that is it's a paper profit or loss. It's not actually underlying earnings. So property companies like ourselves always pull out the one-off revaluations and fair value movements, and that's what an EPRA earnings figure is. So that shows for the year to March 16, we made £7.7 million of underlying profit, up from 4.7 the previous year. And then finally, just to show you the EPRA earnings per share, that is again the underlying earnings on an average share basis. That's 31 pence, and then we paid out last year 16 pence in dividends, and therefore dividend cover was 2 times. This is just a summary of our financial results. So as you can see, EPRA earnings 7.7 million, and then we've got the one-off amounts, revaluation gains of 3.6 million going through, some profits on disposal, and some costs of acquisitions that go through as a one-off. So at March 16, we had just under 175 million of property, which was up significantly from the previous year as a result of those acquisitions Neil's talked through. We had 8.5 million of cash. We had just under 72 million of debt, some other liabilities, and overall that was our net assets, just under 107 million. This is a NAV chart which effectively shows how we are building the value of the business. So March 15, we had an EPRA NAV per share of 396 pence. We issued shares back in June last year at £3.60, so that had a dilutory impact, and then we paid dividends. So from a base of 377 to the year end, we're up to 414. So there was a 10% growth in our NAV for that period. And then this is just a summary of our current debt. So we have our lenders include the main clearing banks, Santander, Lloyds, NatWest, and now, as Neil mentioned, we did have a facility with Barclays on the Halifax property, which was refinanced with Scottish Widows. Overall, we have a very low cost of debt. As you may have picked up, there are plenty of property companies out there who have entered into derivatives, they've entered into swaps, some of them long dated, and the market effectively values those. And we have taken a policy, we've been very careful not to enter into derivatives unless we feel that they are at a good time in the market. So at present, we have the Scottish Widows facility of 15 mil that we fixed back in June at the very bottom of the market in terms of where 10-year debt has gone. So as Neil said, we fixed it at 2.9% all in. That's for 10 years. And the idea there is you match your income with your costs. So we have, on that property, we have a weighted average lease length of over 14 years. So in other words, the income is going to, we have sustainable income there for 14 years. We fixed the debt for 10, so it's a core income producing asset. And then just finally, in terms of the debt, we have this weighted average cost of debt, 3.1%. That was as at March 16. And loan to value, our gearing is conservative at 37%. Richard, shall I pass over to you to talk through property?
Thank you, Steve. What we have here is just some summaries of how our portfolio has changed over the course of the year. And obviously, as Steve has already said, it's going to be updated in the next couple of weeks. But it just shows you how we've managed to change the income streams and what our net position is, and occupancy, and the WALT, which is that weighted average unexpired lease term. So in March 15, it was 4.5 years. And as you can see, we've grown that through acquisitions and through talking to tenants and extending leases to 6.3 years as of March this year. This map just is very useful because it shows you obviously where all our properties are, and you can see that what we've tried to do is we're not sector specific, so we have a number of different properties in different sectors, but also we are looking to buy in very good regional property centres across the country. So Milton Keynes, Northampton, Coventry, Birmingham, Leeds, York, etc., etc. We have a very good, through the purchase of the PIH portfolio, we have a number of properties in the south, but we don't actually own anything in London apart from one small car park. And that's just something that we're very pleased about. So this was our latest acquisition, which we acquired in August. It's a 77,000 square foot office building, moments from Piccadilly, which is the main station in Manchester. And one of the things that we try to do with our portfolio when we're looking into properties is to be buying low capital values, low rents, but close to stations. We think that transport hubs are the key to how this country is going to perform over the next medium and long term. And this is a property where the owner hasn't maximised the value. There are vacant spaces in the building which haven't been refurbished. And as a result of buying the property, we're looking at refurbishing those properties and moving those rents on. When we bought the property, one of the key factors about it was it had a very large car park, and we've taken a planning advice. We think that actually may offer us a medium-term redevelopment play in in 5 or 6 years' time. Broad Street Plaza, Halifax, well, I think as we've already mentioned, this was a financial deal which Stephen and Neil have already touched on, but the key factor here is long-dated income streams led to very good covenants. It's only 4 years old, the building, and as you can see, the key here was actually to refinance the property and take out this loan, which provides us, as Neil said, with just under 17% cash-on-cash return around July, August next year as a result of minimum increases that are due under the rents. This was the building which we bought in March of this year, all fully let. But as you can see, the way it was designed, it was built by the Milton Keynes Development Corporation, you can see they haven't exactly maximised the way it looks. It's not a pretty building, but it is off low rents. And one of the things we're looking at here, and we do have some medium-term development plays if we wanted to, but one of the things we're looking at here is whether we can actually enhance the site by building a much greater development in the long term. The site itself will allow us to actually substantially increase the size of the building. Again here, low rents and 3 minutes from the station, fully let, and as you can see, we've got some very good tenants in there as well, and we're looking to increase those rents by refurbishing space as and when it becomes available and pushing those rents on. Seoul Central Northampton, so this was the last fundraise we did May last year. We bought the building for £20.7 million. As Neil said, it had been in the market, failed to sell, and we came in and bought it. And one of the attractions to this particular building is that there was a lot of space that was occupied by Gala casinos, but it wasn't actually, rented to Gala casinos, but not actually occupied by them. So they were paying rent for another 11 years. But we don't like to just buy buildings that just have an income stream. We actually like to be able to maximise those values. So what we looked at doing was taking back the Gala space and looking at refurbishing it. This is a leisure scheme which doesn't actually have any restaurants in it. And one of the things you want to do when you go and stay in a hotel overnight, or you go to the cinema, or you go to the gym, is actually you want to be able to eat. And for some reason there were no restaurants in the building. So we've looked at reconfiguring the scheme, having replaced the Gala space and converting it into A3, which is the restaurant users. We applied for consent, which we achieved, and which we got granted yesterday, and now we're talking to potential restaurateurs and occupiers about them coming into this scheme. The other thing that became apparent to us about why we should buy this building is all the things that are going on in Northampton. And when you're spending £20 million in Northampton or £24 million in Halifax, you need to make sure that you know all the things that are going on. And the best way of doing that is to meet the local authority, because when you go and sit down and talk to them, they know exactly what's going on. And when there was a property conference every year in the south of France, and we happened to meet the chief executive of the local authority, and he pulled out a map and it showed us where our building is and what's going on and around it. And that convinced us that there's tremendous upside to come in Northampton, which perhaps, although is in the public domain, is not necessarily known about in the whole of the property sector. There is a new student university campus that's being built about 10 minutes from here. It's a £330 million development. They're on site at the moment, and that's going to complete in the next couple of years. Directly opposite this building is an old site which is owned by Kia, a very large contractor, and they are speculatively developing 60,000 square feet of offices. The council really want that to happen, so they've actually taken a pre-let of the space. Even though they don't envisage occupying it themselves, they want to get the scheme going, so they pre-let it. They've done it at a level where they think that they would be able to make a profit rent, but that is enabling that scheme to actually get going. And the council themselves have built themselves a brand new building as well, which actually will complete in the next month's time. So all of those factors are all helping us to make the decision that actually there will be more investment taking place in Northampton. That will bring people into Northampton, and this is the only leisure scheme in the city centre. It's the only cinema in the city centre of mainstream like view, and therefore we see rental growth coming out of this and changing of how this asset will perform. Bank House Leeds we talked about. already. So we bought this in April last year. It's let to the Bank of England, and when we bought the building, they asked us if they could stay. They were paying a low rent, and we negotiated a three-year additional lease term with them. But because they were paying such a low rent, we managed to double their rent as of 2020. We've got we received a floor black from a tenant that wanted a downsize, and we're refurbishing that, and that's going to provide just under 17,000 square feet on one floor, and it will be one of the largest second-hand floor plates in Leeds. Leeds rents at the moment are up to £28 a foot for brand new space, and we'll be looking to undercut the market at £17.50. For us, that will show a tremendous return. We'll have over £1 million worth of income coming in on this building, and as you can see, we bought it for just over £10 million. You can't buy buildings and get a 10% return in this market. High Street Sutton we bought last summer, down the road from the station, low rents, it's let to the council. We've just completed a letting, well, not just, but we have completed a letting to Foxtons. Greater London rents have grown considerably through permitted development of conversion of office space and into residential. That's narrowed the amount of offices available, and we're seeing rental growth coming through from that. Croydon rents are expected to get over £30 a foot, and the council here are paying £13.50. They've got a review next year. We've got a number of other properties that I can talk about that we've done asset management of, and I'll just talk about some of them now. We'll show you some photos on the next page, and I'll just talk about them. But before we do, we should talk about one of our substantial properties in York. This is HUDSON House. It's directly opposite the station. It's 100,000 square feet. We bought this property for £3.8 million on October 13. In March 2015, it was valued at £14.9 million. We have a number of different planning applications that we've received consent on. As you can see, we've got approval to convert it and also to convert into different things, but one of the things that we do is we look to make sure we're maximising value. And we think that we can actually improve the value even further by making a planning application to knock the building down and start all over again. The reason for that is the efficiency of this particular building is quite low at the moment because it's 4 separate buildings all on one site, and we think that we can improve efficiency by knocking it down and starting again. It's directly opposite York Station, and York is a city that has announced that they are planning to spend a lot of money reconfiguring their surplus railway land, and it's called York Central, and it's going to be over 2 million square feet of residential and offices and shops, etc., etc. And that is a 20-year scheme that's going to be taking place directly opposite our building, and we see tremendous rental growth coming from either the offices and the residential. Just some of the photographs of the properties that we own. In Milton Keynes, this is a property which we refurbished for our tenant Rockwell, and we're in the process. We have another building which became vacant recently, which is adjoining these properties, and we're in the process of refurbishing that at the moment. Rockwell's lease was, we took a 6-month letting to Rockwell, and we converted that into a 12-year lease, having spent the money and refurbished the building. They're only paying £10.50. Having done our refurbishment, we're expecting to get over £14 for the adjoining property. That sets the tone, and therefore we see rental growth coming through for these properties when the leases come up. In Dartford, just worth mentioning, because we've got some retail and offices with offices above. The offices are vacant, and we knew that we couldn't actually let those out. So we achieved, through permitted development, a conversion to residential. We're in the process of just finishing the scheme, which is 13 flats, and we'll be renting those out. Again, we're seeing rental growth coming through in the residential market. I'll let Neil finish.
Thank you, Richard. So we're very positive about the future. We're not too worried about Brexit. We think in the short term it'll be a bit rocky, but medium term we think in the end it'll be good for us. So we're very positive about it. We're continuing to look for acquisitions that suit our criteria. You won't believe it, but the portfolio market has actually strengthened since the Brexit market, and it's actually much harder to buy now. But we are quite fussy, we are cautious, we are selective, And when we buy, we do probably more due diligence than anybody. But we think we've bought right, and we'll continue to adopt the policy of trying to buy properties that are off market or have failed to sell. That's really our policy. We are very confident about the future. We think we have the right management team to go forward. We've got good relationship with the banks. We've got good relationship with our shareholders. Over 70% of our shares are held by institutions. So we feel that we can feel very positive about the future. Thank you very much for listening to the three of us.
Hi, thank you. In terms of your fundraise, do you place the shares with institutions, or do you actually approach your private investors as well?
We do both. So on all our fundraisers, we spend time. We think the private investor is very important because as we grow, we need liquidity, we need activity in the market. And to us, private investors are important to us as institutions are. So yes, we do go to institutions, but we go to wealth managers, we go to brokers, and we see private investors all the time. In fact, we've got another presentation in two nights time in Leeds. And I'm going to Manchester tomorrow. I'm involved in quite a large children's charity. While I'm in Manchester, I'm going to see two wealth managers as well. As we go to a city, we automatically go and see people who might be interested in investing in Palace Capital.
Question about returns. I haven't seen any figures about how much capital has gone in. All I can see is that they're now worth 175 million. But how much have you put in?
Yeah, so that really is what that NAV chart was trying to demonstrate. Effectively, we've raised £63.5 million, and that is now worth over 100 million. And I think that's where we like to try and differentiate from a standard REIT, where you're investing for income, but your NAV is at the at the whim of the property market, whether it goes up or down. Our track record shows that people who originally came in at 200 pence, obviously share price is now up at around 360, and yeah, the underlying value of the business is the last NAV per share back in March was £4.14.
You've obviously talked about Brexit a bit. You've done one deal post-Brexit, the Manchester purchase. And perhaps it's too early to say, but do you think regional prices are lower post-Brexit, or is it just that some of the people that would have been competing with you to buy have temporarily dropped out? So in a way, that means prices are lower, but it might just be a short-term phenomenon.
Yes, but what you've had since Brexit is you've had foreign investors because you've now got the pound at 122, so it's 10 to 15% cheaper. I was with a guy from Abu Dhabi 3 weeks ago who bought a building in the Midlands, and he said, I'm buying it at 10 to 12% less than it would have been. So you've got a lot of foreign money looking to buy in the UK, because the UK will always be the UK. It ain't going to change.
Yeah, just wanted to ask you about Northampton. Quite a bit is still unlet, yeah? Vacant. How much, in fact, is vacant?
Do you mean in terms of floor area?
Yeah, floor area, and what is the planning use?
So at the moment it's, we've just actually had a change of use granted for change of use from Gala Casino into A3. So there's probably in total about 45,000 square feet, which was mainly the casino. And we're looking at how we've got plans in order to change that into restaurants. We've got the planning consent now, and now we're looking for the tenants. But it doesn't actually cost us anything. What we did was when we got we did the deal with Gala. We got a rates rebate, and we actually got the rateable value down to £1,000. So effectively, it's not actually costing us money to keep it as it is, if that makes sense.
And the other thing is that HUDSON House. That is currently tenanted, is it? Because you were talking about redeveloping it, possibly.
Yes. So
are they on short leases, or how is
yes.
it? Yeah.
So it's 4 buildings, 3 of which are predominantly vacant, and 1 of which is let on short leases, which gives us that flexibility that we've got some income coming in, but actually when we're ready to, if we decide to do something with it, then we can actually go ahead and do that. But we can't make that decision yet until we get planning permission, and we're still in negotiations and sorting ourselves out with regard to making that application.
I was in York yesterday. I met with 2 councillors from York City Council, because part of the planning process is dealing with the planning officers, but it's also dealing with the members. So we've taken time out to go up there and see them, and we're working with them. So when we started thinking about could the right thing be to redevelop this property, we had to bear in mind that York is an historic city, and they don't often look at things like other cities do. So when you want to knock a building down, you've got to think very carefully about how you're going to approach it. So what Richard and I did about a few months ago is we arranged to see the CEO of York Council. And before we saw planning officers, we saw anybody. And we sat with him and we said, look, we're thinking about knocking the building down. What's your thinking? And he said, you can't do it quick enough. He said, as far as we're concerned, you know, it's not an attractive building. It's a 50-year-old old railway building. He said, I'm very supportive. And then they had an economic development fellow that was there. And what you've got to bear in mind is that government grants to councils are changing in 2020, whereby they will be keeping their rate income and they'll be getting either no government grant or very little. And what's very important to them is to get businesses into York, which is why part of the planning process, we're looking to build new apartments, and we're talking about 132, I think, apartments, but we're also looking to build possibly up to 40,000 feet of offices. Because what we've learned about York is there's no grade A space available in York. And we know from our building in Leeds, the tenants that would like to go to York but go to Leeds because there's nothing in York. So we're very conscious of that. York is a really nice place to be. It's quicker to get to York from London than it is to Leeds. It's an hour and 50 minutes. And that's why Hiscox decided to build their headquarters there in Leeds a few months ago. They built a 50,000 square foot building. So we're very confident about York.
Could you tell us a little bit about the basis of valuation on the balance sheet for your properties, how often they're reviewed, and with particular reference to, let's say, Bank House in Leeds, where you've got 17,000 square feet, which is soon to come available. Once it's let, is there an automatic review of the book value of that property, or does it happen at some point in the future by rotation?
We have our properties valued every 6 months. So they're valued at the end of the year and then it's updated. And Cushman and Wakefield do our valuation, major firm. That's our policy. If Bank House gets let, when the reval comes along at the half year or the full year, it will then be revalued at what it needs to be, having regard to the letting that might have taken place. That's really how it works.
Thank you.
Yes, it's discounted now, while they take into account that there's empty space there.
What would you say, sort of slightly following on from that and following on from the Brexit concerns, what would be our risks and our sensitivities to void periods possibly increasing in general as a result of business confidence and business failures in the future? If that happens, how well protected against devaluations of our properties as a result of voids increasing?
Well, first of all, we see no sign of it. I mean, there really is no sign. Of the properties that we've sold, we've either sold at book or above book value. That's number one. We have interest in all our vacant properties, all of them. We just see absolutely no sign of any downturn in interest. at all. There may be in London, but we're not in London. We're outside London. And when I was in York yesterday, it's quite interesting. They kept saying to me that Brexit is a London issue. We don't even talk about it up here. And they don't. Because as you know, most of the regions voted for out. So as far as they're concerned, they're very positive about it. And you see how positive they are, because we're just seeing absolutely no sign of any downturn in values and any lesser interest in any of our space. In fact, we've got more interest in our space, I would say, than there was pre-Brexit. Yeah, it just depends where you buy.
Stephen mentioned that at the moment you haven't got any swap deals, and in fact, if anything, you've done rather well out of companies who rather inappropriately entered into swap deals in previous years. But then you went, which kind of put my mind at rest, but then you got me a little bit twitchy by saying, well, we would go into swap deals provided that the circumstances were right, which kind of leaves everything open, really, doesn't it? So could you elaborate on that one sentence that alarms me slightly?
Yeah. So, I mean, it would be wrong of us not to consider fixing interest rates at the appropriate time. So we've always got to assess where interest rates are at, where we think interest rates will be. However, we're a property company, we're not a financial management company. And so the point of fixing any interest would, it is always about having confidence, knowing what your costs are going to be in the future, and making sure that's tied in with where your income's going to be. Halifax, we did a 10-year fixed rate with Scottish Widows because we've got strong tenants, good covenants, and we've got an income profile that goes on for 14 years on average. So given where the market was at, we could have, we had a Barclays facility, we were paying a margin of 2.75 plus LIBOR. Even with LIBOR where it's at today, we've managed to fix below that. So, being able to, having security of where your costs are is an important factor. But as I say, we are always considering, what we do when we put a facility in place, effectively it's floating. So normally you have a margin and you'll pay on top of that 3-month LIBOR. What we do is we make sure that we have all the documentation drafted and written up. So if there was a need to put hedging in place, we could do that straight away. Because what you will find is over the market, over the cycles, cost of debt will rise. And at the moment, if you looked at other property companies, there would be very few who have as low a cost of debt as us. And that's because they've got legacy issues, they've fixed at high rates, and we don't have those issues. But there will come a time, and who knows when, currently we're in such a low interest rate environment, we do not see any need to put any hedging in place today.
Have you sounded out recently what a 10-year fixed loan would cost now? Okay, so the Scottish Widows facility we put in place back in June, it had a margin of 2.2, and we effectively paid 0.7% to fix that element for 10 years. Today, I think 10-year gilts are 1.1. So when we originally looked at putting that facility in place, we were expecting to be paying all in of 3.5%. So just given what happened as a result of Brexit, we were able to lock in less than 0.5%, or we were able to reduce our cost of debt by 0.5%.
Yes, you've told us a lot about your office, leisure and retail, but not too much about the industrial warehouse and this car park. And it's quite a small part of your portfolio. Is that because your expertise is in leisure and retail? Why is it such a low compared to sort of other companies?
So we're opportunistic buyers. So when we got offered the Quintain portfolio, there was actually not much industrial in there. Fact of life. When we got offered the property investment holdings portfolio, again, very little industrial, right? There just hasn't been that much industrial. Would we buy industrial? Definitely. We've been looking at one or two portfolios that are only industrial. We'd like to do more of them, but a lot of other people would as well. So, and we like our returns. So yes, we like industrial. Absolutely no reason why we won't have more.
On page 6, your EPRA NAV is 414. Is that on a fully diluted basis? 414?
Yeah, that is,
After-
it is actually, the
Share-
diluted is 414 as well.
It's 414, right?
Yeah.
Okay.
Yeah.
And then your share price is 355 close of business today. So the difference is what the market is basically discounting you by. Is that
Yeah.
correct?
So the
And that's a-
dilution of the shares being traded today is based on that difference.
Okay. And it doesn't take obviously any, this is for 31st of March 2000,
Correct.
is last year's, right?
Yeah.
Last
So we
year's,
will be announcing our half-year results at the end of the month,
half year's,
at
okay.
which point the metrics will get updated.
All right, thank you.
You're a small team. You've done very well so far. I'm guessing a lot has, so far, Neil's contacts, his network, his nous, his experiences had a lot to do with the growth so far, but I'm not denigrating Richard's contribution by any stretch. I'm sure it's important. If Neil had God bless him, a heart attack, if Luton Town won the FA Cup, anything like that, how would things work afterwards, in your view? What's the kind of what's the foundations you've put in place for this organisation?
First of all, we've got a chairman who's a highly successful business guy, Stanley. He came in right at the beginning. He sold his company. He had a share registration company called IRG, which he sold for over 100 million about 14 years ago. He's chairman. But I got two colleagues here that are very, very competent. So I wouldn't worry in the slightest.
Well, I think they deserve a round of applause, so thank you very much.